As you know, topic 6 will begin the fourth quarter and the second half of this course on accounting. At the beginning of topic 6, I gave you a summary of where we are, talking about the topics that we've covered at this point, the different kinds of accounts, the process of putting those business transactions into a journal and then into a ledger. And we also talked earlier in the course about two financial statements, the balance sheet and the income statement. In the course of looking at journalizing and posting, I gave you actually some very simple transactions to journalize and then to post. If you look on your screen, you'll see a sample of a journal. At the top would be the company's name, and then one transaction is journalized there. You had a couple of problems in topic 5 dealing with journalizing, and a couple of the transactions were looking like this. This happens to be dated March 17, 2017. You see salaries, expenses debited for 10,000, cash is credited by 10,000. That's the transaction we had a couple of times. However, that transaction is very simplified. At this point, we're going to take the same kind of transaction and look at it a little bit more realistically as an actual business will do. We will look at an entry dealing with salaries, a company paying salaries, and this will be the context of this particular video. Tomorrow you'll have another video that will go into a bit more detail when we take a look at not only the more complicated journal entry, but then we'll actually post it to the ledger, and then look at a second kind of payroll entry that a company will make. This will be a new entry that you did not have in topic 5. So we're getting a bit more complicated, but as long as you remember the increase side and the decrease side of accounts and the steps in journalizing and posting, it should not be that difficult. First of all, as you might know from your own experience, if you have had a job with a company and have received an actual paycheck, you may well have noticed the difference between gross pay and net pay. The videos that you've seen in the last few days and going into last week perhaps dealt with that very thing. I gave you 3 different videos that talked about the payroll deductions that you see on a typical paycheck. All of those videos were done from the employee standpoint. It talked about your paycheck and your deductions and what that meant going from gross pay to net pay. Now we're going to look at the same scenario, the same kind of situation with payroll, but this time from the company's perspective, and more specifically from the perspective of the accountant. First of all, the government is going to require companies to do certain things regarding their payroll. They can't simply pay cash to employees, write a check for the full amount, and be done with it. No, instead, the government will require companies to deduct certain taxes from their employees. This gets a bit complicated, and we can look at all kinds of different scenarios, but we're going to look at one generalized scenario here with a company that is paying their employees. Again, on the screen you see a very simple entry. March 17, salaries expense debited, cash credited. Now we're going to look at the same entry in a different way, because now the company is going to have to deduct taxes before they end up with net pay that the employee will get. There are a couple different kinds, as you saw in the video. There are different taxes: federal income tax, state income tax, and something called FICA, Federal Insurance Contribution Act. And that kind of deduction deals with 2 government programs specifically. It deals with Social Security, and Medicare. And all of these are programs that require payroll deductions. Now, just a bit about the way the government goes about its business in collecting taxes. You may well know that next month, actually, in April, we have a deadline for people to file their taxes. Your parents probably deal with that uh, very often. You have to pay not only federal income tax and also state income tax. The way this works is that the government will require every wage earner to pay taxes, but instead of waiting until the end of the year to get their money, the government wants it throughout the year. So instead of at the end of the year paying the entire tax bill, the employees will pay it little by little as they go through the year. As they earn money, a bit of that money that they earn will go to taxes. The company then will have to know how to go about deducting money from their employees. And this involves, again, a bit of detail that we don't need at this point, but what we're more interested in is how the accountant of a company will journalize the salary expense transaction that you see on your screen. Instead of doing it this simple uh, method that you see on the screen, I'm going to walk you through a typical example of what that transaction might look like. When an employee is first hired, he or she will fill out at least two forms. One is the W-4 form, which deals with federal income tax, and the other one is the IT-4 form that in our case deals with the Ohio state income tax. These forms indicate to the employer how much to take out of the employee's paycheck each payday. So based on that, the employer will come up with a percentage. We'll get into how that all works a little bit later. The video's touched on it, but right now we're going to hold off that particular discussion until a little bit later. So let's look at the transaction on the screen, and let's take a few things out here. We're going to deduct that, and we're going to deduct the cash part because it's not that simple. But let's say on March 17, 2017, the company is making a payroll. It is paying its employees. So the debit to salary expense is still there. Let's say the total amount that employees earn would be $10,000. So that is still a debit. Now, the credit is a bit more complicated than the transaction that you originally saw on the screen. Let's start to put some things in here. One of the things that you will see credited will be this: federal income tax, I'm abbreviating here, payable. Okay, that's when it says payable, it sounds like a liability account, doesn't it? And it is. This is something that is deducted from the money earned by the employees. So they actually earn $10,000. We're not sure how many there are in this company, but the total is $10,000. That's what they earn. But we are withholding some of that money. So let's assume that we are going to withhold, and there's a way to figure this out for the company, but for our purposes, we'll just give you a number. The company is going to withhold $1,000 for federal income tax. Now, this is money that the employees have to pay. It was taken out of their paycheck. So they have earned it, but we withhold that amount of money. And eventually that now becomes a liability. It's payable. We owe it. Now we owe it to whom? We owe it to the Internal Revenue Service, the federal government. So eventually we're going to have to pay that money. So liabilities here take on a little different flavor than what we talked about earlier. In topic 5 and topic 4 and 5, we talked about liabilities as something that we owe because we got an asset in return. This is a bit different. This is the exception to the rule. We're not really getting an asset for this, but we do owe it. So in accounting terminology, this is a liability. So federal income tax payable, there's a complicated way to figure out how much that would be, but based on the fact that our employees earned $10,000, they're going to have $1,000 withheld. Now, we also have another liability called state income tax payable. Now, that is, again, an amount that varies from state to state depending on how much people earn. But let's come up with a number here, and we'll just give you an amount of $700. So we will have to deduct from that $10,000 that the employees earned another $700 to pay their state income tax. So it's their money, but we're holding on to it, and eventually we're going to pay it for them. Another account is credited. FICA payable, which maybe I should learn to spell. Okay, there you go. FICA payable. FICA payable. FICA stands for Federal Insurance Contribution Act, as you saw in the two or three videos. That includes two things. One is money put aside for Social Security, which is a retirement program for employees that they have to pay into. They don't have a choice here in our company. And also some of it goes to Medicare, which is a health care program for people over 65. Again, it's a bit more complicated than in that simplified version, but for our purposes, that is all we need to know at this point. Federal Insurance Contribution Act puts aside money for Social Security, which is a retirement program, puts aside money for Medicare, which is a health program, both for the elderly. So even though you're maybe 21, 22 years old, when you work for this company, you have to have this deducted from your paycheck. So out of the $10,000, we're going to take some money. So let's say both of those programs, Social Security and Medicare, add up based on $10,000 of earnings, a deduction of $760.50. Okay? Another one. This will be, and this will vary depending on where you live and where you work, but some places have city income tax payable. That is also a deduction. So based on the $10,000, we withhold $200 from the employees because that is required to be paid to the city. So that again is a payable. All of these amounts of money are withheld from the $10,000. So we've withheld money for federal, state taxes, for the FICA, which is health, which is Social Security and Medicare, and also city income tax. So all of these amounts are money that the employees earned, but we held it out of their pay because we will pay it for them at some point. We'll talk about that later. So then we have finally cash. This indicates to us we will credit cash, which means we will lower the amount of cash that we have in order to pay to the employees their net pay. And in this case, it's $7,339.50. Now, if we've done this correctly, these 5 credits will add up to $10,000. So you can check this on your calculator, because debits have to equal credits. So they earned $10,000. They had this much deducted from their gross pay. We'll pay that for them later, and they will actually get $7,339.50. Now this could be one employee, could be 10, could be 15. We don't know that from this entry, but that's the salary expense entry, which is different than the one you had last week. There we simply debited salaries. Expense